Then, as a founder, the other thing that you can use is, and it's not just for founders, for startups. You have to deploy capital to use it for something. That's all finance is about. Let's say you're an NGO founder or a founder where cash is strapped. Now, what? Why would you treat debt as a very important instrument? Is why you should study different kinds of debt. Now, debt is simply liability. So, like we understand debt right now, simply loans. But does it work in the same way as we understand loans? So, in Asian culture, South Asian culture, credit is not a very it's not a very positive thing. It's not very looked towards thing that you would rather look forward to using it in an effective way so as to multiply your capital or your assets that can generate that capital. It could be anything. So your AI researchers are your capital, your patent is your capital, your trademark is your capital, your followers are your capital, your NGOs, operations people deployed, your agreements that you sign, everything is your asset. And given a certain way of evaluating, you can also evaluate it and put it in your balance sheet if you want. More tangibles. So, or goodwill, simply goodwill that exists. It's usually used for other processes than, uh, you know, going through impairment tests that you have to do. But we'll discuss that later. So, I'm focusing on debt. And in the debt, as we discussed term loans. We can go deeper into them in the future. But I want you to imagine debt as it is first. So, what is debt? Is you have certain amount of capital that is deployed and you know its principal and you have to pay a certain interest on it. That's the literal definition of debt, that you need to pay an interest. However, your principal can be paid in many ways. So it can be a bullet loan where you pay it like a bullet. At the end is where the impact happens. So at the end is where you pay back the principal. You can have term loans. You can have convertible loans, which is what a lot of European companies use. I have seen buy and build cases. So what happens is you have these debts where if your company reaches a certain equity value, or you can structure it such. What what is meant by structuring is you can write in legal contracts such that it converts into equity. Why would you do that? Let's say you were uh, giving debt from a giver's perspective, from a donor lender's perspective. You do that simply because you see, if you're funding OpenAI, you're giving that, you rather want equity in the future, it's going to grow in the future. And that's basis how you assess the company and such. Let's say you were funding, I don't know, a biotech thing that may or may not work in the future. Then it depends on you. Maybe you know on a convertible. So, and they have different interest rates simply because it's a convertible debt, right? So you have the power of a higher upside. So you need to be paid lower right now so that your value of debt equalizes. In case you are taking simple debt where you are paying constant rate of interest versus now when you have the option to convert. So this is one form of debt. This is a form of debt that a lot of people understand. So, convertible debts, your other kinds of debt that you have, uh, mezzanine funding, where you have paid in kind interest. What is mezzanine funding? You have paid in kind interest. That is the interest that you need to pay. You accrue it to the principal next year, meaning your principal, let's say with 100K loan, you have 7% interest. Next year, you're going to pay, you know, 7K more. So you're going to pay 7K more. Your principal becomes 107K, and now your interest will be calculated on top of that. This is done simply because let's say you're a company that you want to use your cash as capital to deploy somewhere else. You can use that kind of a loan to do other things in life and not focus just on paying back debt, because I mean debt is an obligation that you need to pay. Otherwise, legal contracts have different kinds of structures where bankruptcy and other kinds of codes can come into picture. So it's better to you have to pay back interest, but then you can also have other kinds of loans. Now this is what creates the maximum amount of fear in people, that because it's a loan, because it's an interest, what you have to do is you have to pay back that thing. And when I'm a founder, I want you to know that this is not important. in the sense, thinking like this is not important. Of course, you need to pay back your interest, but thinking like this is not important. You need to think again as an employee, or you care about your employee, you care about your debt. You have to pay your employee, you have to pay your interest, and the difference is, of course, you need to pay back the principal at some point of time, but it's not always the case. In the case, you can keep refinancing your debt. There's an option I want you to remember. How refinancing works is you take another loan to pay back this loan, standard stuff that a lot of people in the US and North America do. As your interest rate changes, when the Federal Open Market Committee will decide, Fed, as we call it, that they want to reduce the base rate, you will you will also get lower rates, because interest, if it's a floating rate one, how it works is, and most of them are, you have your base rate, and on top of that the bank charges a premium. So the base rate goes down, your floating rate also goes down, and that helps. The other thing you can do is convert it to fixed rate. What happens in fixed rate is you pay a fixed rate, but you can change between fixed rate. It has a harsher governance, things like that, but you can always negotiate. Think of it like capital deployed. You do not need to think of it like it's an axe on your head that it's just cutting off your head. It's not like that. How it works is, you have your employee working there. So you have somebody who's taking care of your revenue, sales people, business development people, marketing people. You have people taking care of your tech. You have people taking care of your product. You have people taking care of your HR, legal, finance, ops. Similarly, this is capital who's taking care that all of these people are paid at certain time, and that the whole thing results in a bigger cake for everyone to enjoy later. Not just you, the society, and everyone in a stakeholder view of finance. So I want you to remember that these is how you should view debt, but also that these are not the only forms of debt. So after this, you also have revenue financing, where you can share revenue, and basis your revenue you can get certain kind of debt. You also have other kinds of simple loans. So loans, of course, it could be asset backed and not asset backed, things like that, securitized, not securitized. You have secured and unsecured, you have those things, but there are also vendor supply and things. So you have vendor financing, where you play with accounts payables and account receivables. Accounts payables, and you give in the future, account receivable and you receive in the future. In the future, mostly after 1 year, simply because that's when you do accounting, as by the definition of finance. However, depends on you how you think it. You do a quarter on quarter thing. Depends. So that is also a matter of financing. So that's what big companies do. They delay accounts payable and they take in account receivables now. So now you have money right now more, and then you need to pay in the future. So money right now is better than money in the future. So that's one way of handling your debt. There's also a form of debt you can take. There's also employee financing that you can take. You can convert a lot of your employee salaries into ESOPs and give them a chunk of the pie, so that they will their interests are aligned, and that in the future, you can right now pay them lesser, simply because you do not have that much, and in the future you can get more. They can get a higher reward, you can get a higher reward, and it shows dedication on your part as a founder that you want to take everybody on board. So these forms of debts exist, and I want you to focus on them. Do not always focus on equity. Do not always focus on VC financing, because it's venture capital financing. They have angel finances, you have private equity, you have banks, literally financial institutions. However, it's tougher because financial institutions, there are regulations on them, they have to obey them. So that's that. Then you have informal ways of lending money. You have other BFSI or NBFCs, non-banking financing corporations, or something like that. So just non-banker financial institutions, financial corporations. So you can use them, or companies, you can use them to get other forms of financing and not be focused on just one form of financing. So this is something I want everybody to know, or me to know. The videos are being made for me, so that in the future you never feel trapped or strapped simply because cash is there in the bank. You have to look at money in this way.